Hello? Yeah. Oh, good. Good afternoon, everyone. We apologize for starting a little late, but we've kind of been waiting for some people whose flights were delayed, and we've decided they're just going to have to get here when they can. But welcome to it's hard to believe, but this is our 6th annual NextGen conference. Our topics this year are based on the feedback that you all provided to us last year, which is oriented towards how to buy a home. And we've got a really great panel of very experienced people here to talk through that process with you all. And then we also have an investment financial markets presentation. I'm also going to ask you all again, we work on this all year, we really do, and we've got such devoted people in our company who really think about this and put a lot of thought, a lot of effort into it. So Claire Johnson and Lily Calvert, particularly for organizing all of this today. And then we have a committee of Kate Lummis, John Kolaw, Alan Lyons, and Lauren Hall, and then Jamie Steen has joined us recently this fall for as sort of an ex officio member. But anyway, it's really, we gather a lot of feedback and ideas and try to make this the best that we can for you all. But key is to tell us what things are of interest at this stage in your lives. So I'm going to hand it over to Claire here, who's going to moderate our panel discussion. But I did want to just give one sort of overarching comment, which is that there's a lot of information. Buying a house is a big step. It's a big investment. But it's also a lot of fun and can provide a lot of long-term benefits. But it is highly regulated. There's a lot of jargon. Don't be frightened of all of that. The key is to put a good team together, and that's who we're going to introduce you to. Thanks for coming.
Let the panel get settled. All right, well, thank you, David. And I just want to echo all of your sentiments and say thank you all for taking your time out of a busy holiday season to be with us today. But before we get started with the panel discussion, I'd love to do a quick round of introductions. One quick thing I do want to say, unfortunately, Ruthie Porterfield, who was on the original program, was unable to join us this evening, but she got us a great replacement. So we'll start with Pat.
Hi, my name is Pat Parkman. I'm a vice president and trust officer with Houston Trust. I've been here for 6 years, and I've been in the trust and banking industry for over 25 years.
So Paul Silverman, I have actually never done anything since graduating college other than real estate. So I've worked in different capacities of the building industry, and in 2012, Martha Turner herself called and invited me to her brokerage where I was an agent for 7 years. And as of August 1st, I became their latest sales manager. This is a topic that interests me because with my involvement at HAR, I was one of the founding members of actually the NextGen Realtor Group. So, which I served on for 2 years and then couldn't serve on anymore because I turned 40 and no longer qualified to be on the group. So definitely glad to be here today.
Melissa Moncrief. I'm a senior vice president in the private banking department at Amegy Bank. I've been in the industry for about 12 years, and we specialize clients with their home buying purchases, refinance, and building homes.
How y'all doing? My name is Mark Herrin. I'm a senior vice president with Houston Trust Company. I've been with the company for about 5 years, and I've been in the trust business for a little over 20 years.
My name's Claire. I'm also with Houston Trust. I mostly do marketing and communications, and I'll be your moderator today. So again, to echo David, buying a home is a really exciting step, and despite all the trouble, it is absolutely worth it. But the goal of today's conversation is to take a really high-level look at the home buying process, and that's everything from deciding if you're ready, to navigating deadlines, to getting the keys in your hand. So I ran the numbers, and our panelists have a collective 94 years of experience, which is pretty impressive in their relative industries. So they're going to be sharing some mistakes to avoid, factors to consider when you're buying a home, whether it's your first rodeo or not. So a couple things before we get started. Buying a home really is a non-linear process in so many ways. You've got a lot of different steps in play at the same time, and one thing that the panel has consistently reminded me of is that no two transactions are alike. And as David said, it is so critical to build a good team. You really are only as strong as the company you keep, particularly when it comes to finding a realtor that you trust, finding a lender that you have a good relationship with, an attorney, a financial advisor. This is something that you'll hear us emphasize time and time again. A couple housekeeping things. Of course, if you have questions, feel free to interrupt. We can take questions as we go along, but we have set aside some time at the end for a Q&A. And for some of the slides that we have up here that have some more technical terms, might be a little harder to read if you're in the back, so please feel free to refer to your printed PowerPoints along the way. So we'll get started. My first question is for Mark and Pat. So often I hear that it makes more sense to invest your money in a mortgage instead of rent, but is that always the case? How do you really determine if it's the right time to buy a home?
Well, I know that a lot of you here are probably already homeowners, but for those of you who aren't and you might be considering to buy a house, probably the first logical step is to look at the economics, to do an economic analysis to determine whether or not you can afford to buy a house, and if so, whether you should. And one way to look at it is that if you're currently a tenant, you're relatively mobile, you have a low capital investment, you're probably part of a lease, you're making monthly rental payments, you've got a deposit on file, and you've probably got some extra cash sitting on the side, or perhaps it's invested in something a little bit more liquid. But other than that, most of the heavy burdens of home ownership and the real commitment of home ownership is borne by your landlord. In contrast, if you're a landowner, if you're a homeowner, well, all of those burdens shift to your shoulders. So in addition to your monthly mortgage payment, if you have one, you're also going to be responsible for paying the real property taxes and other maintenance other than routine maintenance, such as roof repair, foundation repair, and things like that. So it is a capital-intensive proposition. On the other hand, even though it's been said that you typically don't buy a personal residence for investment purposes, you do hope that over time you'll build some equity and hopefully the property will appreciate with the market. And along the way, you should hopefully get some tax advantage to the payments that you're putting into the home. For instance, your mortgage interest may be deductible as well as your property taxes. Finally, it's been said that a home is a castle, and it truly is in most cases. Generally speaking, your personal residence is going to be exempt from seizure by most types of creditors, with the exception of perhaps the mortgage company or the tax man.
Something else to consider is your marital status. If you are married and buying a house jointly, then you're going to want to from joint funds, then that's considered your community property in the state of Texas. If you're engaged or have a significant other and are wanting to buy a house, you need to determine if you're going to buy that as your separate property or as a joint interest. If you're buying it jointly, you probably want to make sure that you're both contributing to the asset from joint funds. If you're buying it as your separate property, you want to make sure that you purchase the house, your down payment, your closing costs, your mortgage payments, any expenses for the house, any improvements to the house, property taxes. You want to make sure you're paying that from separate property assets to maintain that separate property status.
So Pat, I want to dig into that a little bit more. When you bring up marital status, it kind of reminds me that millennials across the board were getting married later, having children later, buying homes later, and we also changed jobs and cities a little bit more frequently. So my next question is going to be for Paul, and that is, do millennials behave any differently when they're buying a home? And if so, is there any piece of advice you would give a millennial home buyer, particularly in 2019?
Yes, absolutely. And just to kind of take off of what y'all said as an investment, another unique thing about a home is it's one of the only investments that you can actually enjoy over the life of it. So kind of has some unique factors. But, we do see a lot of changes with millennials nowadays. It used to be that their preference in homeownership was, let's go out to the suburbs, buy a one-story, two-story home with a big yard. And now, kind of like you said, you brought up some very good points. They're getting married later, changing jobs, changing cities. So we've seen that as a big change in actually what they're looking for. More of them are interested in living in town, living next to restaurants, living in kind of the heart of the city versus some of the suburbs where our traffic kind of keeps building and building. But the advice I give them is, this generation has access to so much data, and it really helps the whole process and helps make a more informed decision. But it still takes, kind of like what we all do, is somebody to take control of that team and give you advice. It's going to have to be somebody with a lot of very good reviews, somebody very well respected, not somebody that, let's just say you went on Zillow and you see 3 names below a property listing. Those are all paid advertisements. So you really need someone that's going to know the area, know, is it a flooding history? Does it have, is it going to be rezoned? There's only so much data you have that you can interpret yourself. Data is not necessarily going to tell you whether you need an underslab plumbing inspection, a stucco inspection, et cetera.
We'll come back to that in a little bit, talking about factors that impact which neighborhoods you look at. But, if you look at the stage of life and you determine it is the right time to buy a home, obviously the money has to be right. So my next question then is for Melissa. How do you kind of run the numbers and figure out how much home you can afford?
Yes, that's a great question. The first thing to figure out is your down payment. So most financial institutions want to see at least 20% down. Depending on the size of the home, they may want more than that. But for this conversation, we'll talk about 20%. And then after that, from a mortgage perspective, the rule of thumb is that you can usually qualify for up to 2 times your annual income on your mortgage. That doesn't mean the value of the home, but how much your mortgage can be. And so a lot of things you'll hear that banks talk about is debt to income ratio. And what that means is as simple as it sounds. It's your monthly debt over your monthly income. They'll refer to it as a DTI ratio. The industry maximum is 43%. So they want you to be below that 43% figure. And so your debt is going to be made up of your principal and your interest on your mortgage payments. Then you also have taxes and insurance on a home, and you may have homeowners dues as well if the area you're looking in, has a HOA. And then anything that's going to show up on your credit bureau report, credit cards, car loans, that types of stuff. Your income is going to be your salary. They're going to give you credit for 100% of your salary, and then where there comes a complexity level is if you've got bonus income, a trust distribution, or income from your investments. Banks like to see a 2-year history of any of that type of income. So if you're in the middle of a job change, I wouldn't suggest buying a home. You want to have at least 2 years of history of any kind of outside-the-box income.
So speaking of outside of the box income, looking at trusts in particular, Mark and Pat, is there anything in particular that a trust can do to help with the home buying process?
Absolutely. Generally speaking, as a trustee, if you're a beneficiary of a trust, we're ready, willing, and able, and perfectly happy to help assist you in acquiring a home. And as it happens, most trust instruments today are drafted to contemplate that the trustee might provide some type of assistance. So the question then becomes, how do we go about doing that? Well, there are generally 3 different options that we might look at. The first option is to simply make a distribution to the beneficiary, whether it be for the down payment, monthly mortgage assistance, maintenance assistance, or a combination of these things. The second is that we can serve as a banker. where the trustee makes a loan to the beneficiary and helps the beneficiary to acquire their own property in certain cases where using a commercial lender might not be a viable alternative. And the third option is that we as a trustee can acquire the residence, and we can provide the residence to the beneficiary. In that case, the trustee holds the property and maintains the property for the beneficiary. But which of these options we employ really depends on the particular facts and circumstances. But generally speaking, we consider it a preferred use of trust assets compared to some of the other lesser alternatives.
The only thing I would add to that is that I like to have my clients go out and get mortgage lending on their own to help them build credit. Because if you have a loan in a trust, the trust isn't going to be reporting to the credit agencies.
Yes, that's a good point. I mean, it goes without saying that your credit impacts you if you're applying for financing, but if you're looking to buy a home in the next 6 months to a year, and maybe you don't have great credit or you don't have much credit at all, Melissa, about how long does it take for someone to really build that up and really look suitable to a lender?
Yeah, so it does take about 6 months to a year to build your credit score. It's not a bad thing, but most millennials actually do not have a credit score. Part of that is because they've been on their parents' credit cards, and so that's not showing up or giving you credit. So a lot of times banks will want to see two different trade lines. One of those is a credit card, so to see the revolving payments go up and down. Then the other one is usually a bank loan, a car loan, something where you're making a monthly payment every single month to see that payment history. Keep in mind, if you're ever late on your payments, you're going to have to give an explanation as to why you were late. And a credit score is important from a bank's perspective. It will affect your interest rate. It will affect the amount of money you have to put down on a home. And sometimes poor credit can actually affect your ability to get a mortgage. So if you don't have credit and buying a home is something you want to do in the next 6 months to a year, I would reach out to your trust advisor at Houston Trust and have them kind of explore options with you on what's the best type of credit for you.
I want to switch gears a little bit and go back to something that Paul said earlier, talking about factors that impact which neighborhoods you would consider if you're looking to buy a home. And this is kind of a two-part question. But A, how is home value really determined? And we've got some comps here up on the slide for some Houston neighborhoods that we'll walk through. But how is home value determined? And then are there any surprising factors that impact home value that you should keep in mind when you're looking?
Yeah, absolutely. So, the question of how much is a home worth is something that we struggle with daily. Really, a list price is completely irrelevant. The two things that matter are what are the comparable sales that have been adjusted show the value is, and really at the end of the day, it's what is the value to the buyer. Listing price means absolutely nothing. I mean, we kind of hope that they're fairly close, but listing price is completely irrelevant. Some of the things to watch out for, and it kind of goes back to having somebody on your team that can look for these things. There's a lot of things that are going to impact value. Power lines, railroad tracks, road expansions, high rises, being built in your backyard. A lot of things that you need to be aware of that just looking at a home and looking at the pictures, you might not know. And then down the road, all of a sudden, it's harder to sell that home when you're looking to move up to your next one.
What about things like school zones, or if you're
Right.
living in a immediately post-Harvey Houston? I mean, how do those things come into play?
Right. So school zones obviously is very important for a couple reasons. Number one, school zones do have the right to kind of redraw their lines and change up the schools that you're going to, or your kids will be going to. What we've also seen during some potential or some other times where sales were surging is that some schools were actually over capacity. So let's just say Briar Grove. A couple of years ago was over capacity. So you buy this $1 million home, you move in, it's zoned to Briar Grove, you go to enroll your kids, and next thing you know, they're not going there. So it's definitely something to keep in mind. Post Harvey is another very good question. We have seen some very positive things. For example, the Braze project where they're expanding the bayou and how that's going to actually take some homes out of the flood level or flood zone. But really, it's going to go back to kind of the history of flooding. Harvey is on our minds because we just went through it. A lot of us don't remember Allison. Different floods, different times. And so really, Really, you just need to, assess what the risk that you're willing to take is. Generally, if I've got a home in Meyerland that had an inch of water and they're doing this project to take it all out of the floodplain, I might be more comfortable than when someone has come to me and said, well, the house had 4 feet. What are the chances we have another Harvey again? Well, it's possible.
Anything can happen, right?
Correct.
And one other question, buyers versus sellers market. Can you talk a little bit about what that means if you're looking to buy in a buyer's versus looking to buy in a seller's?
Correct. So great news for everyone in the room that's buying is this is generally definitely a buyer's market. What we look at industry-wide is whenever we reach 6 months of inventory, that's where we consider it equilibrium. More than that, we're in a buyer's market. Less when we're in the seller's market. So definitely now is a really good time to buy. Inventory levels generally overall are up. If you own a home and you're looking to move up, again, you might take a little bit of a hit on the one you're selling, but what your investment that you're going to maximize by getting hopefully getting the discount on the bigger one will help offset that.
And one final question on this topic. Well, actually, let's go ahead and get to the next slide.
Okay.
One more question for you. So before we get into the next 2 stages of the process, we're going to kind of try and go over some key terms for those of you who maybe haven't bought a home before. I mean, really buying a home has its own language. So I think one of the most important terms to kind of wrap your head around is earnest money and earnest money contracts. So we've got an example up here on the screen. And Paul, I'm hoping you can walk us through kind of how this kicks off the home purchase process, and then also these 4 steps that a home goes through when it's under contract.
Sure. So let me go with the latter first. So when you're looking on har.com, that's the only name that comes out of my mouth because I'm on the technology committee, so I'm a little partial. But when you see these statuses, active means it's active for sale on the market. Option pending is once you go under contract, you normally have what's called an option period or an unrestricted right to terminate. That indicates the home is in that period. Pending is basically that period is done, it's waiting to close, and sold is sold. There actually is one other one that's PS, pending continue to show. And that, you might have a buyer that there's just things with the contract where you're not sure that it's going to go through and you still want to show it. So there's another one's PS, that's pending continue to show. So that's the key thing when you're looking on HAR is just really what you want to be looking at are the ones that have an A for active. So the good thing about Texas is we have state promulgated contracts, which basically means, our broker lawyer committee has agreed on these contracts, and we are essentially filling in the key terms of it. We're not like some states where your contract starts with a blank piece of paper and it's negotiated every little item. So what normally happens is once a realtor has given you your comps, you've agreed on value, you make the offer, go back and forth. When it's accepted, it's actually called the executed date, which is very kind of morbid for such a happy thing you're going through. But that's the date that everything is signed. At that time, you will put usually 1% of the purchase price at the title company as earnest, or let's call it good faith money. In the Texas contracts, like I said, you normally have the unrestricted right to terminate, otherwise known as the option fee, which is actually made out directly to the seller. Within those, let's just say it's 10 days. If you terminate the contract, if everyone signs a release, which they should, you get your earnest money back. Your option fee is surrendered as kind of the price you paid to keep it off the market for that time. So after that, or during that time, you'll go through your inspections. Once we get that done, you'll go into the appraisal period. You also have 2 things have to be qualified. The buyer and their credit worthiness has to be qualified. And what a lot of people don't know is the home itself has to qualify. Mainly that means an appraisal. Once that happens, it's the happy time. We go to closing, everybody signs their papers, and you get your keys.
2 follow-up questions. One,
Sure.
You said that these contracts are, kind of set by the state. Are they identical if you're buying a new home, if you're buying a home that's for resale, if you're buying a lot? Is there any variety there?
Very good question. So in the resale market, we rarely see anything other than a state promulgated contract. There is a state promulgated contract for new construction as well. The one thing to be very, very wary of is builders will have their own contracts drafted for them. And trust me, when they do that, they are heavily, heavily weighting everything in their favor. And so it's, you could walk into a model home, let's say, meet with a builder, they pull out a contract, it's not the state contract, and it's heavily, heavily weighted in their favor. So just know, and that goes back to your realtor's advice and your trust attorney's advice, make sure you know what you're signing. There's actually one builder that basically strips all your consumer rights away in their contract, and people will sign it all day long not knowing.
So avoid that if
Hey,
possible.
Claire, can I jump in here really
Yeah,
fast?
of course.
I'm going to make a sales pitch for Paul and his team, but I think it's really important. I am not a real estate agent, but I deal with the purchasing process all the time from the mortgage side. There's a lot of homes in Houston that trade off market, but it is so important, especially if it's your first time, to have a real estate agent. There are so many dates in the contract that you are responsible for, and if you miss those dates, you could be out option money, you could be out earnest money, and so it just makes it a much smoother process if you do have an agent involved. You might be saving 3%, but I can promise you you're going to save yourself a lot more headaches if you have an agent.
Yeah, there's some areas worth spending the extra money in, I can
And
imagine.
I will also say that having a good lender will also help protect your investment and your earnest money. And I mean, you think about it, you have earnest money, you could be out inspection fees, appraisal fees. I mean, there's a lot on the line to not have a very well orchestrated team working in your behalf.
But to that point, I mean, is it okay to walk away from a home that you're maybe for some reason not comfortable with? I mean, is there a time when you've put money into it and you just have to say, it isn't worth it?
So I tell people it's one of the hardest, best decisions you'll ever make. You know, I never want anyone to feel pressured. I never want anyone to feel like it's not the home for them.
Right.
And so ironically, you know, it happens from time to time. I've never sat at a closing with a buyer buying the second home when the first one didn't work out that they've said, you know, really that first one's really the one we wanted. It never, ever, ever has happened.
Good to know.
I think that's a good point, and I'd like to reiterate that the earnest money contract, once you sign this, both parties, it is legally binding. So even though you're sitting down with your real estate agent and filling in the blanks, if you will, each of those blanks does take legal effect once all of the parties have entered into the contract.
Yeah, talking about all the things that kind of go into motion from that moment you all sign. Of course, financing, applying for that mortgage, that's kind of the next key step. And Melissa, my next question is for you. Again, kind of looking back at some of these key terms we want to define for y'all. Difference between pre-qual, pre-approved. I mean, do these letters, once you get them, you're good to go? Can you kind of unpack that a little bit?
Absolutely. So, two common terms that you really do hear a lot in the mortgage world are I'm pre-qualified and then I'm pre-approved. So a pre-qualification is what your real estate agent, once you engage them, is probably going to say, have you been pre-qualified? And what that means is that you've applied for a mortgage. They usually go through an online portal, you input your income, and it allows the bank to pull your credit. That's about it. They're getting a first glance at you. They're saying, okay, what they say matches what they say. We're going to go ahead and give them a letter. That allows your agent to then write an offer and say that my buyer's been pre-qualified and they're up to X amount in financing. And that helps. That definitely helps from a contract perspective of if there's two contracts going to the table and one has a letter and one doesn't. Usually the one with the letter sometimes carries a little bit more weight. Pre-approved is that you've actually supplied all the documentation. I will tell you, it's a lot of documentation through the mortgage process. You're going to have to supply at least 2 years of tax returns, 2 pay stubs, and at least 2 months worth of bank statements, sometimes even more, depending on when you've been pre-qualified versus pre-approved. So think about it. If you start the home buying process in January, but you don't find your dream home until June, all the information that you supplied in January has now essentially expired. So your credit is good for 90 days, and then any bank statements or trust statements that you're going to send are going to be good for 60 days. And a bank will pull your credit again before you close. So if you need to buy a new car and you're under contract on a home, don't buy it until after you've closed on the home. We've had a few people buy cars, 2 days before they go to the closing table, and they can't get a mortgage anymore because their ratios are out of line. And so keep in mind, the bank will pull your credit again.
I would imagine, does the same apply to maybe changing jobs while you're in the middle of all that?
Yes. So don't do a job change in the middle of the 30 days you're under a closing process.
If you can help it, right?
Please don't.
Okay, can I add one thing? As an agent presenting contracts to sellers, just know it does matter whose name is on that approval letter. You know, when I see, let's take Amegy, I know they're, you know, a strong local bank, that is going to be weighted differently if we have equivalent offers versus a mortgage company I've never heard of, or, you know, a bank that has a horrible reputation. So all letters are not equal.
That brings up a good point. I mean, we talked earlier about how, you know, people in my generation maybe tend to go to, I'll say HAR, I won't say Zillow, HAR when they're looking for a home. But I know there are online lenders, like, how do you feel about those?
Let me take this one. So I've had this happen with clients where they've done this. I've had stories of, we've had the loan officer, processor, and underwriter in 3 different parts of the country. I've had the same situation where the loan officer goes on vacation, does not put on their out of office notice, and we've lost 2 weeks in a transaction because no one's picked up the ball and run. I think there's something to be said for a lender that, in this case, you could walk into her office, great building, great real estate company in that building. But no, seriously, that you can walk into their office and talk with someone, and if things get bumpy, you can go talk to them and have some control over the process versus, well, the app seemed like it was great. The app's not going to help you when you run into speed bumps. Sorry, go ahead.
No, you're good.
Okay.
He said it. Don't always shop for the lowest rate is what I'm going to say, because
Yeah.
you'll want to talk to your lender at some point, and you can't call someone through an online app usually.
Good to know. So when you're talking about looking at mortgages, kind of figuring out what's right for you, I mean, I hear a lot about kind of ARM versus fixed. Can you talk a little bit about the differences between those two, and maybe when one might be more advantageous than the other?
Yeah. So I'll break down the 2 different types, because a lot of people know what an adjustable rate mortgage is, but besides that, they really don't know what it means. So you're going to have 2 types of mortgages in the industry. You're going to have a fixed rate mortgage, which means your rate's fixed for either the life of the loan. The most popular out there are a 15-year fixed and a 30-year fixed. The other side of the table is an ARM, which is an adjustable rate mortgage. Those are usually a 30-year note, a 30-year amortization, but they've got a different type of interest rate. So for example, you could have a 5-1 ARM, a 7-1 ARM, or a 5-5 ARM. And so what that means is, on the slide we have up here, the first 5 years, for example, on the 5-1 ARM is going to be fixed. So if your interest rate is 3.5, you're going to have 3.5 for the first 5 years, and then after that, for the remaining 25 years, your rate is going to change every single year based on the market rate. So a great question to ask your lender, if an ARM is your option that you pick, is, what does my rate do after my fixed period is over? What's your ARM disclosure? Does it move each year, and how much? It's not a silly question to ask. They're not going to think you're dumb for asking it, but you have the right to ask it, and it's worth asking. We put up this diagram for y'all to kind of see. So for this example, we used a 10-1 ARM, and the rate is 3% versus a fixed rate of 4%. If it's your first home and you know you're going to be in it for 5 to 7 years, I would recommend an ARM. In this example, you would have saved $50,000 in interest over the 10-year period. And if you go to sell that house at the end of the 10-year period, you've paid more into your equity, and you've also saved on a monthly cash flow basis. Now, on the flip side of it, if this is your forever home and you're scared of the interest rate market, a fixed rate is not a bad deal. It's still a great option, and in 10 years from now, if interest rates have gone crazy, you're fixed at the same rate you started at day one. And so a fixed rate's not a bad deal, again, so I don't want anyone to think that you shouldn't do a fixed option. You just need to kind of know, what's your life plan look like? You know, what season of life are you in?
With all this news around interest rate cuts, I mean, how do you know, once you're in it, is it a good time to refinance? How do you make that decision?
Yeah, so refinance definitely gets a very big market push when the Fed starts to cut rates, because most mortgage companies set their rates based off of the 10-year Treasury. And so, as y'all know, that's taken a hit in the past 2 months and could potentially take another hit over the next few months. But basically what that means is, in a refinance situation, the rate usually needs to go down by 1%. And the other thing is you usually need to stay in the home for at least another 36 months. And the reason why we say 36 months is there's closing costs associated with a refinance. There's usually an origination fee. You have to get a new appraisal. If you've done any work to the structure of your home, you're going to have to get a new survey. Sometimes the title policy requires a new title commitment. So for you to break even on the savings that you have for the lower monthly payment, you've had some costs come out. So usually you need to stay in the home for at least 36 months.
You and Paul have both talked about a lot of different expenses associated with buying a home. That runs the gamut from the down payment to the inspection fees to the origination fee. So how much cash do you need to have in your pocket before you make an offer, and how long? Something I hear a lot about is funds needing to be seasoned, like they need to be in your bank account for a set amount of time before you move forward with the offer. Is that?
Well, I'll let her talk about the seasoning part, but I mean, really the search should start with meeting with someone like her and having them run all these numbers and give you a true cost or a true estimate of what you can, or what's affordable. And then I'll let her take the costs and closing and all that stuff.
Yeah, so kind of rule of thumb, again, we're talking about if you're going to put 20% down on a home, I would at least have 25 to 30%, not necessarily in cash, but in some sort of marketable securities. And so you're going to have the 20% that you have to put down at closing. And then you're also going to have an origination fee. You're going to have the inspection fee, which Paul can kind of tell you that can be in range of a fee depending on how many inspections you have to do on the home. And then you have to have closing costs, which are your origination fee and then anything that the title company is going to require. From a cash reserve, banks like to see you have some sort of reserve in your pocket after closing. We don't want you to put every single penny into the house that you have. We need to know that you've got some reserves for if you need to make repairs, or if you do lose your job 30 days after closing, are you able to make your mortgage payment? And typically when you're getting a down payment, you ask the seasoning question. That's a mortgage term right there. So what they're trying to see is that you've at least had the funds for 60 days. A lot of times we'll have clients say, oh, but my parents are going to give me my down payment as a gift, or I'm going to borrow my down payment from my trust. That's fine. You don't have to have that money for 60 days in your account prior to closing, but just know that the bank's going to ask for a gift letter, and they're going to ask to see that you've gotten those funds at least prior to closing. So at least usually 10 days before closing. So just keep in mind, if a gift is in your down payment calculation, just make sure you've let your lender know that, because that does require some additional documentation.
I want to ask one more question about kind of inspection fees. We've got quite the range up here, $500 to $10,000. And Melissa, I know you mentioned that it kind of depends on what the home needs. But I mean, would you say this is an area that's worth splurging in? Does it save you money down the road?
Absolutely.
How do you assess?
Absolutely. You know, if you're buying a home that's stucco, no reason not to. I mean, stucco inspections are about $1,000, but anyone's ever seen a stucco repair bill? That's small change. There's things like under slab plumbing inspections. There's mold inspections. Really, it's gonna be a thing of you evaluating the cost of it. Mm-hmm. You know, inspection fees can get up there, but I always have my clients even get inspections on new homes. And even if, they always find something, but even if they don't, just a peace of mind knowing that you've done this is well worth it. So I've never, other than, I can't think of anyone that's wasted any inspection money. But I will say that watch who you're taking advice from. You know, if you come from, let's say, the Northeast, your parents might tell you you've got to get a radon test. Well, that's not really applicable down here. So, but you're never ever going to waste inspection money because it gives you the peace of mind.
Yeah, that's priceless. Okay, so moving into the final stage of the process, the close. So this is something y'all are going to have to look at in your printouts, all the fine print, but talking about what a close really looks like, both on paper and in person. I feel like Melissa and Paul can kind of tag team this one, since the lender and an agent are both at the table.
So for those of you that haven't purchased a home, what you're looking at is what they call a closing disclosure. For those of you that haven't purchased a home in the past 5 years, this is what used to be your HUD. So this is the document that basically walks you through what the buyer is bringing to the table and the credits that the seller is getting. And so it just it itemizes everything out. And at the very bottom, you can kind of see how much the borrower has to bring to the closing table, and again, how much the seller is getting. So do you want to walk through the actual what happens at a closing?
Yeah, and so let me just say that, so what is actually on the screen is it's sometimes referred to as the Alta. Basically, it's an easier version of how to tell what you're paying for. The actual closing statement, the government decided we would add 2 more pages to it to give you a better idea of what your cost of credit is, and just kind of confused everybody. So make sure when you're closing, you ask the title company for a statement like this, where you can clearly see debits and credits on each side. So generally, the closing will start with, the lender and closing disclosures. Usually the day before, the day of, we will do a final walk just to make sure the home is still in right condition, repairs have been made, etc. And then normally at the title company, the seller will sign first, the buyer will sign second. Once they're done signing their documents, they will take what are usually called the funding documents or documents to fund, send them to the lender. At that time, they will they've already released the wire or will release it then. The home is funded, you're officially closed. That process, the funding process can take I've had it take 10 minutes, I've had it take 4 or 5 hours. But once it's officially funded, congratulations, you're officially a homeowner, and you can enjoy your home.
All right. Well, to kind of wrap up the process, if I could hear from each of our panelists and have you give your number one piece of advice that you would give a home buyer. Pat, we'll start with you.
I'd say just make sure that you can afford the house you're buying, not only the mortgage payments, but your taxes and insurance and any unexpected repairs that are going to come along the way.
So mine is start the process early, start researching the neighborhoods, talk to your lender, talk to your trust attorneys, do all of your, boots on the ground work up front. Because the last thing I want is for any of you to have to make a rush decision and buy a home and 3 to 6 months later realize it was not the home, not the right area for you. So do your homework early so you can make an informed buying decision when it's time to purchase.
Be patient and don't be afraid to ask questions. It's a long process, but it's a fun process. And just everyone's been a first-time home buyer at some point in their life, so there's no question that's a stupid question.
I'd say whether it's your first time to acquire a personal residence or your 10th time to do it, as exciting as it is, it can also be a pretty stressful time. So you should put together a good team of professionals to assist you through the process. And that would include a licensed realtor, a good mortgage broker, an attorney to review the documents. And if you're working with Houston Trust Company, engage us in the process. We've shepherded many a beneficiary through it on multiple occasions, and we can help to relieve some of the stress that you might be otherwise experiencing through the process.
All right. Well, before we start the Q&A, let's give our panelists a round of applause for their expertise and honesty. All right, so we've got about 5 minutes before we need to jump to our next presentation. So if any of y'all have any questions for any of our panelists, please feel free. Lori? Right. A 15 to 30 fixed?
15 and 30-year fixed. A 15-year fixed rate is just going to be that your life of your loan is 15 years versus the life of your loan is 30 years. So your payments are going to be accelerated much faster. So your actual monthly payment is going to be much higher than it would be on a 30-year note. But usually your interest rate on a 15-year fixed is lower than it is on a 30-year fixed. Does that help? Yeah. So if you go online and it says that you don't have an 800 credit score, that you have terrible credit, that's not true at all. If you have anything in the 700 range, you're doing great. 680 is kind of the line where anything below that, you're going to have to explain why you don't have a 680. But anything in the 700s, you're looking good.
Anyone else? No? Okay. Well, thank you all.
Well, thank you all. Panelists, that was really a lot of very excellent information. I'm now going to introduce, I did think about this. I met an Englishman once who said, "I just love America. You can go into any gathering anywhere in any part of the country, any socioeconomic situation, and always start up a conversation about real estate." And I think that's probably a unique American thing. And I'm going to introduce our next speaker, who's going to talk about sort of some investment concepts around residential real estate. Neal Dikeman. I think it was inevitable that Neal would come here to speak to our NextGen at some point. Matt and I first met with Neal several years ago when he was heading up the alternate energy investment fund for Shell, Royal Dutch Shell here, and we were going to have him talk about non-renewable energy and things like that. Well, Neal went into the residential real estate business as an investor and developer, and so we never did do the thing on alternative energy, so we're here to do real estate. Neal has a BA in history and economics from Texas A&M, and he's after the finance, the finance roles at Royal Dutch and Bankers Trust. He's now the managing partner of Old Growth Ventures. So welcome to Neal.
Hello, thank you very much. So, as he said, I'm actually a reformed tech entrepreneur. I started off in Houston, got a history degree, had enough accounting and finance in order to get a job, which was really good. I needed a job. And eventually stumbled into private equity in California at the height of the dot-com boom. And after stumbling out of that, because it made no sense to be in manufacturing in San Francisco in 1999, I got into tech. And I only made it back home to Houston in 2010. And when I did so, started to do some of the same things that my father and my grandfather had done before me, which is buy rent houses. My grandfather was a poor farm boy, went to Texas A&M and lived in West Houston, and they basically didn't trust the stock market or banks, so he'd assume mortgages and take over rent houses in the 60s and 70s. And then my dad and mom grew up doing some of the same things. So we were a lot smarter than we realized. About December of, I think, 2017, the Federal Reserve put out a paper saying that, well, basically, the idea of putting money into index funds and rent houses was the smartest financial strategy for the last 100 years. What they really said is they built a time series for 100 years, including kind of rents and capital gains for houses, to kind of see how the investment performed as an investment class. This is the first time it had been done, and surprise, surprise to them, they found that residential real estate basically matched equities with lower volatility, which, if you understand finance theory, you know should not actually happen. You ought to have to pay a premium or pay some volatility penalty or something there, but it doesn't. Arguably that's because it hasn't really been an institutional asset class, arguably because the rents are a bit higher than the dividend yields, but regardless, this has actually been a good investing strategy for a long time, and this paper kind of provided the theoretical underpinning to what my grandfather started doing because he was a poor farm boy. So I started buying houses when I got back in 2010, and my first house cost $58,000. That house is probably worth close to $250,000 now. That was luck. That wasn't because I was smart. I then basically got knocked out of the market, and at one point was 0 for 30 on contracts because I wasn't willing to increase or reduce our returns profile, and so I was just getting beat left, right, and center. So I figured we got to do something different. So I'm not doing exactly what my grandfather and father did before. We figured we got to start specializing. I'm a history major, and I finally get to work in my field. So we're buying antique houses, picking up a whole bunch of tax credits to rehab them and restore them, and turning them into long-term, absolutely gorgeous, cute rentals. And by the time I'm done, we're going to have 1,000 of these things done across Houston and Texas. So last year we raised a fund called the Historic Preservation Fund, and this is a fund that basically does exactly what I just said. We find antique houses, we buy them, we rehab them, and it's pretty much a full construction project. Soup to nuts, we're rewiring all the way to new kitchens, touching every single surface. And we're doing only projects that can pick up these tax credits under the historic tax credit programs at the state and federal government. I like it because, as was one of the city planners here puts it, this is what they call naturally occurring affordable housing, or NOAA. And it's about as sustainable as you can possibly get. You know, I see no reason to bulldoze a little old, cute house that could be restored just to put up a townhome that's 3 times the size, doesn't live very well, has 3 flights of stairs, and nobody actually wants to pay for. But that's what land economics has been dictating, so we're running kind of the anti-townhome strategy. But while doing that, you spend a lot of time working on just basic residential rental economics and how it works and how to make money in it. So I'll give you a couple of examples of some of our projects, and then we'll go through what I call our rules of engagement, what I was taught for how not to lose your shirt when you're buying rent houses. So this is 908 Sabine. This is one of my little cute Victorians. It's in a neighborhood called Old Sixth Ward, which is right off Washington, just west of downtown. It is magical Victorian fairyland. If you haven't been there, there are 200 Victorians. It's the best collection of antique houses in Houston. It is gorgeous. And I happen to have 2 of them. One is this cute little folk Victorian down at the bottom. The roof there does actually keep out water. We just left the rust so it would look pretty. And the back one is a Craftsman. The front was built in 1890 and the back one in 1915. Neither had been touched in literally 10 or 20 years. They were basically sticks with termites. We did everything to these houses. They're 900 square foot, 2 ones, and we reran wires, plumbing, HVAC, every surface. In fact, took all the siding off that little Victorian, sanded it all down, painted it, and put it back on, and still did it for about $100 a square foot. This is Houston. You ought to be able to build anything for $100 a square foot. So we had about $100,000 into each one of these structures. They rent for $2,200 a month each, and total net cost was somewhere around the high to mid 4s. So right at this 100 times a month's rent multiple that I'll talk more about in a minute. That was my pilot. That was the first time we proved you could actually pick up these tax credits and do antique houses under the tax credit program, and we actually got those through the Certified Rehabilitation Program of the National Park Service. The houses we're doing right now are just down the street from them in the Heights. They're 1922 Craftsman, cute as a button. They were all but 1-1s. If you think about it, these houses would have had 4 to 5 people living in them in 1922. At 769 square feet. So again, when these houses were built, I can actually pull the original permits, and you can see those 2 houses together, side by side, were about $4,500 for the land and the building. And they rented for between $20 and $25 each a month, roughly 100 times a month's rent. A lady named Miss Canfield lived in the one on the right, built and rented out the one on the left, and she bought these things from O.M. Carter, the guy who founded the Heights. She was a widow, and this was basically her income. They didn't have asset managers to help her out them. She just kind of took her money from she got and built a house and actually sold canaries out of the backyard as well. So this is the next project we've got going. There are 10 of these gorgeous little puppies. They are from 1913 to 1922. These are the last shotgun row in Freedmanstown, which is one of Houston's original historic neighborhoods. It's actually the original African-American community in Houston was right west of downtown. In 1920, Houston ended at basically Waugh. There was nothing real west of there. So you think about it. Think about the River Oaks houses are typically 1910 to 1930 era houses. The Sixth Ward, some 1890s houses. So you can actually track Houston progress by the age of some of these houses. So these are the cheapest construction you could possibly have done at the time. They were the townhomes of their day. They just stuck them, one right next to each other. They are 522 square feet, 13 feet wide, 40 feet across, or deep. They are shotguns, one room behind each other. We will put a small addition behind each one, just like we're doing on the Tulane houses, and we're going to push them to be 2-2s. They'll be right at 1,000 square foot. They will rent for somewhere in the high to mid 2s. They'll probably come in all in the low 200s. Yeah, I think I should be south of my typical 100 times a month's rent on these, and we'll see where they comp out. There are no comps for product like this, but since you cannot touch anything in that part of inside the loop for less than $300,000, $400,000, they probably will comp out reasonably well. Right behind them today is the Dolce, yeah, which are luxury apartment complexes, yeah, renting for more than what these guys will probably rent for. Yeah, and so what you see is this really interesting mix of we're having, you know, a tremendous densification in Houston that is probably, all else equal, pushing up the value of single-family homes, assuming they don't get torn down for condos. What happened in Houston in 1999, we reduced our minimum block size from 5,000 foot to just over 1,500, which means all of a sudden for the last 20 years, you could tear down a house and put up 2 or 3 condos or townhomes on the same lot. That's what has driven this condofication of Houston. It is also one of the things that's helped keep our housing prices down, so don't get too mad at it. There's pros and cons with all these decisions in life. Yeah, in our case, what we've been able to find is there are still ways, even in the inner city, to get good rental economics, but not usually. Usually to get these kind of rental economics, people are going to Katy, they're going outside, not the loop, but the Beltway, going to the Woodlands, Magnolia, trying to pick up things where you can still get the rental economics, just like my granddad did in Spring Branch in the 60s, when Spring Branch was basically the end of town. So I was taught rules growing up with real estate, and I'm going to tell you what I was taught, and you can see how many of them you think still apply today. The first is kind of you are what you eat. My dad used to say, well, you know what, you got to focus on something. There's no barriers to entry in this business. Anybody can go buy a house. It is not hard. And you don't even need a lot of money. What he did was every time they could scrape together $10,000, which was basically a 25% down payment on a $40,000 house in 1980 in Spring Branch, you'd go buy a rent house. So everybody that they knew, all of their friends owned rental property in the 1980s. And then most of them, after the Houston crash, got out. The only people who stayed in were people like my parents that did enough of them to have a big enough base to justify the time, and who specialized. In our case, my parents only did one neighborhood, and literally only one neighborhood. It's Bingle and Long Point and Hammerley and Wirt. That's it. That's almost every house that they bought was in that stretch. So you knew that neighborhood cold. You didn't have to run comps. You literally had bid on every single house there. You'd been in 20% of them. We had friends from church living down the street. So if you want to see your empire, you go drive your neighborhood. My real point is you have to do something that is specialized, is focused. I know nobody in the real estate business that is successful that is not ultra focused. Now, maybe they're doing just tilt wall industrial buildings. Maybe they're doing only strip centers for medical retail companies. It doesn't matter what it is, but you got to do something that you're a specialist enough in so that you're not just competing with the general herd, and you become the marginal dollar there. The first rule I was taught was everything's worth 100 times a month's rent. That really equates to about 12% gross, and at about a 2/3 margin, about an 8% kind of cash on cash yield. That gets you back to something a little bit higher than what what that Federal Reserve paper said the return should be. So what this means is if your house will rent for $1,500, you should be into it for no more than $150,000. Now, in Houston, the average house sells for about 150 to 200 times its equivalent rent. The house y'all live in, probably it's a $400,000 house. You probably aren't going to get $4,000 if you want to go rent it. You'll probably get, say, $2,500 or $3,000. That's just the market, because when these neighborhoods gentrify, homeowners will pay a little bit more for a forever home than it's worth as a rental. So you got to be super disciplined if you're going to buy in and do it as an investment. Remember, go back to the Delane houses and those Victors. Those things have been trading at 100 times a month's rent for literally 100 years. Interest rates have fallen a lot since then, so it's possible you can adjust that number up a little bit. Tax code has changed, so it's possible you can relax that, and you'll see investors paying up to about 130 before everyone drops out. But these numbers still aren't bad. They're still a pretty good rule of thumb to follow. Next rule, and this is the one to live by. you buy, doesn't matter whether you're buying it for rental or for your forever home, you buy the smallest house on the biggest lot in the best neighborhood with the best schools that you can afford, and you won't lose your shirt. We have a corollary to this. We now believe that you can replace the word best schools with best commute and still be okay in Houston. In the 60s and 70s and 80s and 90s, that probably wasn't true. School district boundaries, not just the district, but the school zone boundaries dominate. Even my own house, if I go 200 yards north, it'll drop $100,000 just because of the school boundaries. Yeah. However, I have friends that live basically first exit outside of the loop on I-10 and will not move one more exit farther out because they can't handle that extra 5-minute commute. They just won't do it. So the world's changed. However, what you do have to keep in mind is, are you buying that land, which is arguably an appreciating asset, as it gets more scarce inside town, or are you buying a house, which is a depreciating asset, and the typical rule of thumb is you just wait for those things to cross and then you sell the land. You would bulldoze the house and sell the land. You see those guys up at the top, those are my Tulane houses. There's nothing around them that's less than $1 million. So I may not make a lot of money on them, I might not have done everything perfect, but we're not going to lose our shirt on this property. Rule number 3, your home is not an investment. And I've repeated this 3 times. And if you take nothing away from this, repeat it 3 times. That doesn't mean your home is not an asset. Doesn't mean your home is not a great forced savings plan. Doesn't mean it doesn't have tax advantages. What it does mean is you probably will not buy your home for 100 times a month's rent. You probably will spend more making it and keeping it nice than you would if it was an investment. You won't manage it the same way. It could be an investment, and you may make a lot of money on it. But just keep that in mind, that you've got some value in that home that may be investment value, but there's also some luxury value. And you just got to be careful mixing those two up. Rule number 4, and I use this line in every presentation I've ever given, speed kills. And it kills in numerous ways in the real estate business. So I told you at one point I was 0 for 30 on contracts. Look, a good house that's priced right as a rental is going to go within hours. You don't have a day to think about it. It is gone. Just write the contract and see what happens. If you wait till the next day, it's gone. Some houses that are good opportunities will wait forever because they're overpriced and they haven't had their come to Jesus moment and they're not ready to actually do a deal. But the moment they're ready to go, then they make kind of their adjustment in price to what the market will bear. It will go in hours. When you're developing or when you're building, development costs are basically 1% a month. And that sounds high, but you got to pay interest, you got to pay your property taxes, there's always some overheads, there's insurance. By the time all is said and done, somewhere close to that number, you're going to be eaten. So if you take 2 years to fix and repair your house, you just ate 20%. Somehow, the dollar is going to fall out of your pants as you walk. So getting it done quickly really, really changes your game, which means you need to be prepared to go when you buy the house. Your crew's got to be in there that day. You're at 100 times a month's rent, you're losing that out in rents. You're losing out the gross revenues. So once that house is not rented, you got to get it turned around now. Hopefully get it at least before the last tenants are out. Because those turnaround costs, not just the cash you got to put in, but the lost rents, they destroy your economics. Raw land needs to appreciate 3 to 5% a year just to break even. If you think about it, this Houston, 2.7% is your property taxes, plus a little bit in insurance. Ignore your cost of capital. If you're just buying and holding land, it's got to break even. You don't break even until it hits that level. You haven't even gotten into the money. Any way you cut it, speed kills. Now, you can't really recover from overpaying, but you can hold on to it as long as you've bought right and your numbers are making some profit. You just basically accept in a slightly lower cap rate. So what happens if you're taking land and you're building something new, like these condos or townhomes or a single family that gets torn down and rebuilt? You're not flipping, you're rebuilding. How do those numbers work? Well, my dad taught me, and it's still about true, that a house needs to cost a new house needs to cost about 3 to 4 times what that guy paid for the land in order to make margin. And a rough illustrative explanation is here. Let's assume you want to make 10 to 30%-ish on the development. That doesn't mean that's your profit, because most of these things are levered kind of 75% or 80% or 3 or 4 to 1 or 5 to 1. But you got to get enough profit on that house to justify your time. So to get that profit, you got to put enough square footage there to justify, to get to that 3 to 4x number. And so if you pay $100,000 for the land, you got to at least be able to get a full $100,000 structure to sell. Otherwise, there's no profit. This is what's driving land economics in Houston. Now, if you're buying a rental, why does this matter? Because this is what the guy who's going to bulldoze it and is bidding against you for that land is looking at. And if he can make better money on this than you can, he will outbid you. So you actually want to know this number before you make your own bid, because this is actually a competition. This is probably the highest valued use of that property. So tools and concepts, and we won't go through a lot of this, but a couple that you should keep in mind. The biggest one to never forget in rental property of any type, whether it's single family or multifamily, is deferred maintenance. And deferred maintenance is essentially defined as that money that they did not bother to spend and should have. Or the money that you haven't spent but should have. So when you're selling a property, if you haven't put any money into your property, don't expect to get a premium price, because you didn't put the capex and you didn't keep it up. And if you're buying from somebody who thinks their property is awesome, but they haven't actually put any money into it and it's deteriorating into the ground, you got to take that off the purchase price, because you're going to have to spend that, or somebody is at some point. And the other one to keep in mind is the occupancy rate. You live and die on keeping a house rented. And that occupancy rate, and traditionally in Houston, that would have been in the low 90s, 92 to 94, 5%. Today, it's probably a little bit tighter, closer to 100, but this is a tight market. It will not stay a tight market forever. Maybe 95 is acceptable. If you're in the 80s, you're probably going to lose money. So when I value houses, I have this my little tear sheet, and I don't actually put it on a spreadsheet. I just literally scrawl on a piece of paper while I'm looking at the house. But it's the things I want to know. I want to know what's the land worth. I want to know what that highest valued use is. I want to know what my comps are for that house as it is right now, and what the comps are for that house as completed. I want to know what the rental comps are. And we actually run distributions across neighborhoods and build little scatter plots just so that I can try and buy at, say, the 20th percentile. If I'm buying a bottom quarter house on a couple of metrics, you're probably going to be okay. And you got about an hour to do that, remember, because you got to write the contract today, because it's going to sell within hours. This is back to why it's good to specialize in something, either like in our case, historic houses, or in my grandfather's case, a specific neighborhood that allows you to do this effectively very, very quickly. Flipping, the other main highest valued use. Flipping did not exist 20 years ago. It did not exist 10. It's a big market today, providing a very, very needed service, because they're basically turning over homes that most homeowners would not have the cash or time or inclination to fix themselves. Flipper margins, 10 to 30%. They're not actually that much different than developer margins, but they're probably quite a bit riskier. Same deal, speed kills. The basic economics here, what these guys are doing is I'm trying to get 10, 20, 30% margin. I'm trying to do it on 75% leverage. And so I'm essentially trying to double my money in 6 months, including my time and my capital. So if you're fast and you don't blow projects, you make good money this way. None of this is done with your own capital. In almost every instance, it's done on hard money or investor loans. So they're carrying a pretty hefty interest rate. And if they spend too much time doing it, if this becomes a 12-month project, they are probably losing money. It will probably cost them more to do the deal than they're going to make out of it. Heavily susceptible to two variables: that rental timeline, not necessarily the cost, but the timeline, and how much you paid for the land. Most good flips where they make a lot of money, they got a really good deal on the land, and that's covering all the normal construction ills. On the rental, kind of key concept is it is not rocket science. You can actually pay somebody to do it. It takes about 10% of the revenues to pay somebody to manage it for you. But it's not hard to do yourself. Rule number one is simple: keep it rented at all times. As my sister says, she has on the wall of her office, she's got a little plaque that says all employees will be busy at all times. The equivalent here is please keep your house rented. Yeah. What my mom in an up market, that's easy. Somebody doesn't pay, you evict them immediately, yeah, and get somebody else. In a down market, not so easy because you got to worry. Can you get another tenant? Can you get another tenant at the same price? My mom used to carry people in down markets in West Houston when the market was really weak in the 80s and 90s. Yeah, and you got to adjust. If you kick somebody out, you got to find the market price to get someone in now. That same property that sits there for 5 months trying to find an extra $200 a month rent, yeah, that's not going to make you your money because you're paying property taxes every month. Yeah, you got to manage the costs. Same deal. You got to turn around fast. Speed kills. Typical margin ought to be in the 60% range on a cash margin. Yeah, I've got some houses that are probably well into the 70s. The big REITs that do this professionally that you can go look at the comps on, they're down into the 50s because, well, I don't know why they appear to be just taking people's money and throwing it down a rat hole. But, yeah, somehow they're down in the 50s. And finally, yeah, this has been mostly about residential real estate in single family. The other main category is multifamily, and that would take us a whole other presentation to go through. But since you'll run across it a lot of times, you want to kind of understand some of the basic key differences. And I look at multifamily, usually those little fourplexes in Montrose, things with garage apartments. Yeah, they're not too far afield. You get a little bit more economics of scale. Okay, yeah. You got a whole bunch of them to rent together. Maybe you can afford an apartment manager to do it. You get some construction economics. Apartments usually rent for less than houses because of the common wall. Nobody wants a common wall. Apartments are more commoditized. When the market turns down, you tend to see more volatility here. So you got to be a little bit more careful with them. The rent multiple, that 100 times, you want to get better than that on a multifamily apartment complex. However, today, it's such a hot market because the industry is trying to chase, investors are trying to chase yield, that cap rates have actually been bid down on multifamily, in some cases well below what you would traditionally accept for a single family. So we're in kind of a weird time right now for multifamily. SFR, you might see a gentrification uplift. On a multifamily, you are going to sell it for a cap rate. You can push up the rent, reduce the operating costs, but they're still going to buy it from you based on that cap rate, that how much they make in that year divided by the total price of the property. SFRs, less barriers to entry, but also pretty fungible. You want to sell a house, I can sell it in 90 days. You call a broker and they will get it. There is a price that will get it moved for you right now. On an apartment complex, you can't just go sell a piece of that apartment complex. You might have partners in there, you got time to get out of it, so it tends to be a little bit more illiquid asset. You can do apartments in almost any neighborhood. Not all neighborhoods make good SFR rentals. Yeah, let's pick on River Oaks again. If you think you can get a rental to work in River Oaks, you are smoking something. There is absolutely no way. Now, just outside of River Oaks, 1,500 yards away, there's a few spots where you can find some okay SFR rentals, but for the most part, SFR rentals have been a suburban type thing. It's been either the neighborhood that has not yet gentrified or deep suburbs. That's changed somewhat in Houston given the densification and the gentrification we've seen. But you do actually have to pick neighborhoods, which you don't really have to do as much with apartment complexes. And then you got to keep in mind the customer segments are actually different. 2/3 of Americans, or about 65%, traditionally have bought. About a third, or 65, or 35, 37%, have rented. Today, there are people in both categories that could easily be in the other. There's people that could buy that choose to rent, and there's people, that vice versa. So we actually spend a lot of time thinking about who is our customer, just like I did in our tech startups, not just the property itself. When I design, and when I say design, everything from paint colors to we do not do a property without a dishwasher and without a indoor washer and dryer, because you cannot hit a premium rental if you do not have those. And to make our numbers work, that pays. My mom, back in the day, she won't rent them with a refrigerator because she got tired of cleaning out refrigerators. So you want to rent one of her properties, you bring your own refrigerator. Now, that's obviously a different market, but it's a very effective one. So whatever you're doing here, multifamily, single family, just make sure you know who your customer is, because that person that's signing the lease and sitting across from you, that's actually your customer who's going to make you all your profit. Any questions? Yes, sir.
How did you come up with the strategy to pursue the historic tax credits?
Absolute dumb luck. I was blown out of the water in Spring Branch. I'm 0 for 30. So I figured I'm going to do what I wanted to do in 1998 when I was just out of college working downtown. I wanted to buy myself a cute Victorian in the Heights, live in the garage apartment, rent out the house. This was my goal. Wasn't a bad goal. I just moved to California before it happened. So I'm like, look, I'm going to go to the Heights. I'm going to find me a little old Victorian. I like Victorians. And I bid on one. It was a duplex with a garage apartment. And the guy wouldn't let me buy it unless I told him about the historic. He told him I understood how to deal with the historic districts, which is its own little zoning board in Houston. I lied and told him I knew all about them. Put in my offer. Backed out of that house later because it was too riddled with termites even for me. While going through the process of learning the historic districts, there was a little tear sheet that said economic incentives for doing historic preservation, listing all of these tax credits. I'll bite, that sounds like free money. So I started to research them and realized that everyone had been doing them for large multifamily, big commercial for 30 or 40 years. Nobody had done the residential model, frankly, because the paperwork is an absolute nightmare. There's those Victor houses, there will be 60 forms go in on those. 60 to Texas Historic Commission, National Park Service, Comptroller's Office, IRS, the State Historic, or the Houston Preservation Office, et cetera, et cetera. It's a paperwork and overhead nightmare. We figured out, and on those first 2 pilots, how to basically shrink that down to cookie cutter it to figure out our strategy. I didn't know if it would work until we finished those projects. I put basically $500,000 in to go try it. And we were pretty sure we could make it work, but nobody had ever done it before. After a year of that, we now have what we think is some barriers to entry for our strategy. So we've got something that's specialized, something that's differentiated. I know the market likes what we're doing because they rented in hours. And that was actually my big proof point when I had 2 people standing in between them arguing about whether they wanted the Craftsman with the open floor plan or the Victorian with the high ceilings. I'm like, all right, we know the concept will fly. But it was literally dumb luck of just bidding on houses until I found something that was different and unique and it was worth doubling down on, and then a year of time to develop that.
Neal, if you turn in all the paperwork to get the historic designation, is that for sure thing you're going to get it, or what's the percentage chance that you're actually get approved?
It's the government. It depends. It's a reasonably predictable process, just paperwork intensive, and it depends on the property. Some of them are easily eligible, though we have to put up a full project plan of every stick, every surface, every material, everything we do in every room, and that you could get rejected, and people do. What we have found is if you pick houses that are easy to get through the plan or the program, your rejection rate's probably fine. If you pick your favorite house and then try and rip out a bunch of walls and change stuff up that obviously doesn't follow their guidelines, your project risks probably go up. So we attempt to design the project risks, the net tax credit project risks out in the purchase itself.
What are your thoughts on short-term rentals?
I love them.
Properties or Airbnb?
I've never done one and I love them. I want one so bad. I haven't yet have a property that was really a great fit for that. One of my investors, however, she bought a property. She stole it from me. I wanted this property. It is a cute as a button in the Heights, little 2-1 with a pair of garage apartments behind it, one up, one down, built in the 30s with an antique asbestos roof. And which is asbestos roofs will last forever as long as they're not busted up. And she and her husband restored this thing. And oh my God, they did an amazing job. Well, she has her office in the front and Airbnb's the bedroom for $70 a night. And then has the garage apartments. One of them hasn't been finished. The other one she rents out. As a garage apartment. And that Airbnb basically covers her office. Houston's a little tough for vacation rental market. Because hotels just aren't very expensive here. So the margins aren't probably as good as they might be in some other cities. I think there's a lot of money, especially with a neat differentiated product, to do well in that. But we, frankly, to be honest, I haven't tried it yet. So I'm hoping one of these properties we finish in the next 6 months. We're just going to take one and Airbnb it for a while and see what happens, just so I can get the data on how you would do that here. And there are actually investor loans now that are tailored that will actually let you do vacation rental properties, just as an investor, that didn't exist 4 or 5 years ago. Yes, sir.
Could you speak
So I think it's a post-financial crisis has been the bulk of the change. My understanding of the legal change that permitted it was the change of the minimum block size for residential, and in 20 years ago. So it feels like it's picking up steam. I don't think it's going to stop. Land economics are dictating this. I mean, quite frankly, it is really, really hard, if not impossible, to make money doing single-family construction inside the loop. The land costs too much. So if you go look at those Heights houses of mine, I was into them for $265,000 per lot. Right? So bare minimum, the 3 to 4 times multiple, I need $1 million house just to break even on that project. Well, how many people can afford $1 million house? That's not a huge subset of Houston. So your market just shrunk, right? So if you want to get that down to 600, I got to basically put up three structures on that particular lot. And so that's what's driving a lot of this densification, is simply the commute has driven, and the desire for us to live all close to amenities and in town has driven up land prices to the point where you got to get enough square footage in order to justify the numbers. And I just don't see that stopping.
You investing in other markets?
We will, yeah. Construction, this is not just rentals. You got to know your market, and I got to run construction projects. So our first 100 or so homes will be here, and then we're going to pick up another city. There's 35 states that have tax credit programs, so we'll find ourselves going farther afield. But probably next we go to San Antonio or Austin or one of the older cities. Houston's actually a pretty new city. Yeah, so we got maybe 30,000 houses pre-1930, 150,000 houses pre-1940, maybe 400,000 pre-1960, something like that. San Antonio, if you want to go pre-1900 or pre-1920, San Antonio and Austin have a much bigger housing stock. But it'll take me a year to learn that market. I mean, there's a learning curve. We good? Thank you very much.
Well, hi, everybody. My name is Matt Caire. I'm a Senior Vice President of Investment at Houston Trust Company, and I'm going to close us out with a financial markets update. It's always nice doing these updates when the market is up 26% for the year. Makes things a little bit more upbeat. At the same time, I do realize I am the only person standing in the way of us in the bar, so we'll keep my comments as brief as possible. But do stop me at any time if you have any questions. I thought we'd start with just a recap of what transpired between now and this time last year, so Q4 of 18. Then give us a little bit of flavor of what we see in the current market environment, and then close out with our 2020 outlook and some closing thoughts as well. So just diving right into it, if you recall last year, it was pretty volatile at this time of the year, Q4 of 2018. Some major themes, if you will, were the U.S.-China trade war was just starting to heat up. The Federal Reserve was in the process of raising rates. They had started raising rates several years back, but they had raised substantially last year. Investors were starting to get concerned about slowing global growth, and there was also kind of geopolitical flares, on the rise. I'd mentioned the rise in rates with the Fed. So this is a chart of the short-term interest rate that the Fed controls. And you'll see last year, they were really in a tightening mode. This kind of spooked investors because when the Fed does tighten financial conditions, that increases the capital costs for corporations. It also increases interest costs for us as consumers, increases mortgage costs as well. So that acts as a damper on growth. And you'll see last year the Fed had increased rates for the fourth time. That led to the market thinking rates were going to continue to increase, and that in turn led investors to be a little bit fearful. It kind of spooked them, if you will, which led to this 20% decline in Q4 of last year. This is from peak to trough, and this is the S&P 500. We also saw volatility spike as well. So you may have heard of the VIX index. That's sometimes referred to as the fear index. And that kind of highlighted circle there was December of last year. So again, there was a lot of fear in the market this time. I will note, though, as we look on the right side of the page, we're at kind of the lows in volatility this year. So it has been a very tame market in terms of volatility. Excuse me. So really, what happened though from Q4 to today, we saw a very abrupt shift in the market and the market sentiment after the sell-off last year. That low that you see there towards the left side of the page through today, we're up, again, about 26%, but based off that low, we're up over 30%. So what changed? What caused the market sentiment to shift so abruptly? Well, number one, the Fed did what we call an about face this year in 2019. After that volatility that we saw last year, the Fed came out and said that they would consider cutting rates, and they very much did so. They cut for the third time this past month. So again, that does ease investor concerns. It lowers the cost of capital, and it's also bullish for risk assets, stocks included. A second factor as well was earnings continue to remain strong. Again, looking back this time last year, there was a lot of investor fears that earnings would continue to trail off and would weaken going into this year and even thereafter. But that wasn't the case. That's not what we saw. So when we walk through this chart, the S&P is that yellow line there, and then we've overlaid trailing 12 months earnings in orange. And you'll see, through this year, earnings have continued to remain strong even after a strong rise in earnings last year. This is a closer look at the earnings picture. This is quarterly earnings going back to 2008. And what we see kind of towards the right side of the page, this strong rise in earnings, that was really the benefit of 2017 tax reform. So as you recall, that lowered the corporate tax rate, that increased earnings, capital earnings, corporations earnings, excuse me. And so people thought, or the investors thought that 2019 would be a pretty tough comp for earnings growth. It'd be very tough to meet or exceed what we saw last year in terms of earnings. And although we have flatlined, we haven't seen a decrease in earnings. So it's very bullish for stocks in that sense. So with that backdrop, we thought we'd walk through just the current market environment, what we're seeing there. And really, no matter where you are across major asset classes, you experienced a positive return this year. So this chart is kind of hard to see, but hopefully you can read it on paper. But this shows major asset classes in terms of the returns year to date. This includes everything from stocks, bonds, commodities, emerging market stocks. But really the place to be this year is U.S. domestic equities, and that's represented by the S&P 500. That's the blue chart, or the blue bar there on the far right of the chart. If you extrapolate that return out to today, we're up closer to 26% on the S&P 500. So it's been a very strong market. When you look kind of under the hood, though, in terms of the different sectors that comprise the S&P 500, there's 11 sectors, and we kind of decompose that return for the overlying index. You'll see some of the sectors that have really driven the market this year. Number one, notably, is tech. That's the best performing sector this year. It's incredible. It's up 41% for the year through November. That's followed by communication services. That's kind of the Facebooks, the Googles of the world. And then all the way down to energy. We all kind of know the energy story here in Houston, at least. But energy, even with kind of low commodity prices, it has posted a strong return, although it has trailed the market, the broader market. Notably, though, no sectors are in the red, so all 11 sectors in the S&P are up this year. So that is a sign of a strong market. When we look at valuations, though, within these sectors, some are a little bit more stretched than others, notably real estate in terms of REITs, real estate investment trusts, so that's publicly traded real estate. When you look at the price to earnings ratio, the trailing earnings ratio, that's at about 49 times today. So it looks a little bit stretched. That means investors are paying $49 for every dollar of future earnings. But notably, there's some sectors towards the bottom, like when you look at financials, it looks relatively attractive at about 14 times earnings. When we look at the market as a whole, though, this is the S&P 500 forward price earnings ratio. So it's a forward-looking indicator of valuations. It looks at expected earnings next year. We're slightly elevated relative to history. So you look at the 25-year average, we're at about 16.2. And today we're closer to 17.5 on the S&P 500. So slightly overvalued when you look at these other different metrics in this kind of the box towards the top right of the chart. You'll see most other valuations within the S&P 500 point to a slightly overvalued market. However, when we adjust for the fact that interest rates are so low, this is a way to look at the relative valuation of stocks versus bonds. And this is what's called the equity risk premium. We follow this pretty closely internally at Houston Trust. This looks at the earnings yields, the inverse of the price to earnings ratio, and compares it to the 10-year Treasury. And so given the fact that rates are so low, stocks look relatively attractive by comparison. Looking back, this goes back all the way to the early 60s. So here we're looking for a higher number. And today we're at about one standard deviation above the long-term average. So stocks, given the fact that rates are so low, look relatively attractive. Speaking of low yields, this is a look at developed market 10-year yields across the world. The U.S. is here on the left side of the page. You've got places like France, Japan, and Germany that have negative interest rates. So that's kind of a perverse situation where you actually pay to be a lender of capital to the government. But the main point on this chart, though, is if you look at the kind of the square dots there towards the right or towards the top of the chart, you'll see that's where yields stood about 12 months ago. And notably, no matter where you look across the board, yields are lower today. So all that being said, we did want to close with a 2020 outlook and then also just some closing thoughts as well. And I want to leave you with kind of 3 reasons to be optimistic here. Number 1, the U.S. consumer is in great shape. The consumer represents 2/3 of the U.S. economy. So they're really the backbone of kind of our economic growth here in the U.S. Secondly, central banks around the world have entered into an accommodative stance, so they have been easing and cutting rates. And notably, they've done this at the same time, so it's kind of a coordinated effort around the world. That in turn stimulates risk assets like stocks. And that also lowers, of course, yields across the globe. We just saw that on the prior chart. So all that is very bullish for equity investors. Low yields, low cost of capital, that tends to be bullish for stocks. A few charts on the consumer that I'd mentioned, given the strength of the consumer. A few ways to measure that or to look at that. Number 1 is when you look at the balance sheets. The U.S. consumer here, it stood at about 130 trillion of assets. When you subtract out the liabilities, that's about 16 trillion here in the U.S. That leaves you with the household net worth, which is the bottom right chart. And we're at a new all-time high of net worth. So when consumers see their asset values rise and their net worth rise, that tends to instill a lot of confidence in the consumer. So they go out and spend, and they're able to buy houses and the like. Also with kind of the fall in interest rates, and given how low yields are in absolute terms, when we look at the top chart there on the right, that's the household debt service ratio. So that's a measure of basically consumers' debt service costs relative to their income. So lower rates, again, will lower that, kind of that debt service cost for consumers. In turn, leads to a healthy consumer. Also as well, when we look at unemployment here in the U.S., we're at 50-year lows. That's the gray line there in this chart. So at last tick, it stood at about 3.6%. So consumers in great shape again by this measure in terms of strong job growth and the availability of jobs for most people out there. The other line on this chart on the left is the wage growth line. And while we're below the long-term average of 4%, it is trending in the right direction. So we are seeing strong wage growth here in the U.S. It stood at about 3.5% as of last count. And again, the chart on the right, when you kind of decompose the components of GDP or our economy, the consumer makes up about 68% of that. So again, a strong consumer is really the backbone of our strong economy here in the U.S. I'm going to skip these next 2 charts just in the interest of time, but did want to kind of close with our summary. So again, this is the largest bull market, longest bull market in history. We're 11 years into a bull market. But notably, bull markets don't die from old age alone. When we ask our managers out there kind of what they're seeing in terms of their outlook, they would say that it's very unusual to find a recession in this type of environment where consumers in great shape, yields are falling, they continue to fall. And notably, that last bullet there, investor euphoria is almost non-existent. So when we look back in time to prior market bubbles or market peaks, we tend to find that there is a lot of euphoria in the market. Investors tend to be fully invested. They're very bullish. There's a lot of kind of sentiment driving that kind of top in the market. And we just don't find that today. Most investors are pretty fearful even today, even after the strong run in the markets. And we have noticed there is still a lot of cash on the sidelines. So there's no signs of kind of this euphoria that tends to be present at market tops. So that's a good thing. That being said, though, risks do remain. We're going into an election year in 2020, so that does tend to add some volatility to the markets. The trade war is still very much intact today, so we're looking to see how that gets resolved. And there's the ever-present geopolitical risks and kind of your typical kind of standard characters there that appear in the headlines. So that being said, we think volatility will likely persist going forward. But I think it's important, to maintain that long-term perspective as investors. That's something we try to do every day at Houston Trust. We kind of match, the investment objectives and the goals to the investment horizon for our clients. And I thought this was a very kind of illustrative chart. This looks at 20-year returns by asset class. You can see kind of the green bar there is the S&P 500. So over the past 20 years, which does include the prior two bear markets, the tech wreck of the early 2000s, and then also the 2008 financial crisis, but still so, the S&P returned about 5.6% per year during that time frame. Diversified portfolios, which are kind of the 60-40 mix of stocks and bonds, earned about 5%. But notably, the average investor over the same time frame earned less than inflation. They earned just under 2%. So kind of what's the cause of that? What's driving that? And it's really when investors try to trade in and out of the markets, when they try to time the market, that's very difficult to do successfully and consistently over time. So we think, the next bear market is eventually going to come, but the best thing to do is just to ride through that volatility. Everybody in this room has a very long investment runway or investment horizon, just given your age. So you're able to ride through that bear market and experience the recovery in stocks. This was another interesting chart, kind of illustrating that point. This is from Fidelity, but it looks at going back to 1980, so almost 40 years. If you stayed fully invested over that time frame, you can see the blue bar there on the left is kind of your growth versus $10,000 invested in 1980. But if you missed the 5 best days of the market at that time, you would have lost about a third of your growth or your potential growth. And if you missed the 10 best days in the market, you would have missed over half of your potential growth. So we think that's just illustrative of the point of staying the course, riding through the storm, so to speak. And 2020 is going to be kind of an interesting time. We have a lot of developments that are coming through, as I mentioned, like the election. So we'll all be interested to see how it plays out. We hope to see you all at the next kind of spring investment conference and NextGen conference going into the fall. And so hopefully the market will be good to us between now and then. Happy to answer any questions that you might have. Well, great. Thank you all. Yeah.
Thank you, Matt. That last chart always is a reminder. Best 10 days out of 25 or 30 years. So here we are at the conclusion. I want to first thank our guest panelists, Paul Silverman, who stepped in for Ruthie, Melissa from Amegy, Neal, Dikeman, and then Pat, Mark, and Matt from Houston Trust. Y'all have been very patient and practiced a lot, and you did a wonderful job today. As Matt alluded, we'd like to have more of an investment-oriented series of events in the spring this year that would be kind of a series of 2 or 3 lunch and learn kind of small, shorter programs. And so if you will please fill out your evaluation and questionnaire to give us the feedback that we need to organize the next one of these. So this was Houston Trust's 25th year. We celebrated our 25th anniversary at a really festive event at our new office downstairs on the 2nd floor in October, when we're inviting you down there next. We also want to mention that our website was launched yesterday, a new website, after working on it for about a year, a more modern look, and that'll be up in the conference room downstairs. And finally, let's go downstairs to get a drink from our friends at Eunice, who are our favorite neighbor. Thank you all.